The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A modest push higher in equity prices, a massive drop in the volume of shares traded. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off to closing bell here in the U.S. on this Friday. We do have a little bit of a rally on our hands. The S&P 500 higher by about 0.4%. Not a big day in terms of trading activity, as Romaine was saying, even though we did have SK Hynix, that huge foreign listing coming stateside. It's not necessarily being reflected in enthusiasm for the Philadelphia Semiconductor Index. Only just about flat on the day, though technically the color is green. Wanted to take a look at Brent. Of course, it's been a volatile week here. Brent pretty much unchanged on the day, maybe a little bit lower, trading around $76 a barrel. And then 10-year yields also pretty quiet, a basis point or two higher, though we are still above 450 on your 10-year yield.
Absolutely, a pretty midday when it comes to some of the trading activity, but we should point out, at least for the S&P 500, we are headed for the 13th weekly gain in the past 15. But we should point out that the momentum and the intensity of that rally has eased amid these thematic rotations, the drop in volume, a drop in index level volatility. That backdrop, though, is likely to change next week with an earnings season that has been front run by one of the most aggressive upward revisions in estimates by Wall Street analysts. It's an atypical move to set the bar high that's almost guaranteed to also heighten post-earnings market volatility. As for today, the market seemed to digest the volatility test of another mega equity listing. Just 5 weeks after SpaceX raised $86 billion, South Korean chip maker SK Hynix nabbing $26 billion in its U.S. debut. Take that $100 billion in AI-related listings, add in $100 billion more on the IPO runway, then combine that with $200 billion in bond market borrowings by hyperscalers like Amazon and Meta. The sum total in barely 7 months is staggering. The upside is that we now know for sure that the capital for the AI build-out is there. And based on comments this week by Micron, by Meta, and SK Hynix about using that capital, we now know an expansion of capacity is afoot to supply more chips or computing power. What we don't know is whether the demand side of that equation balances out. Ankur Crawford said this presents a business cycle test, and it's a test that she says she's not too worried about the industry passing.
I think it's tricky in part because we've never seen a market that has grown and grown at exponential speed. And what I would say is that with agents and agentic AI, the amount of compute that is going to be required is almost impossible to fathom.
And, you know, Katie, while SK Hynix isn't giving a broad lift to the market, the size of that deal is just a reminder that AI is still what dominates everything.
Absolutely. And Romaine, of course, mentioned those bond market borrowings that we've seen to fund that build out when it comes to AI. So I thought we'd take a look at the performance of the bond market overall, because you think about spreads, we haven't seen too much upwards pressure, even though we've seen all of this issuance coming from the tech sector. But when you do break it down at the sector level, the story gets a little bit more interesting. I have a bunch of interesting spaghetti behind me. What you need to know is that tech here is in white. You're taking a look at total returns year to date, and you can see just over there at the end of the chart over there that tech really is now in negative territory when it comes to total returns. That blue line that you see is the high grade bond index overall, and your best performer, probably not a surprise, that's in yellow, and that's energy. So you are seeing some sector specific pressure when you think about the absorption of this supply, and you're seeing that increasingly in tech.
Well, let's get some insights out of CreditSights as we kick you off to the close with Winnie, Cisar, Global Head of Strategy over at CreditSights. And Winnie, we talk about the hyperscaler CapEx spending that's now roughly matching the operating cash flows, and buybacks are giving away to a lot of these big bond deals. You have a lot of long-dated AI paper out there. I am curious about just the character, the credit character, I guess, if you will, of what we're seeing in the tech space and whether that is actually changing before our eyes.
Hey, Romaine, happy Friday. Yeah, it's a great question because we do have these hyperscalers that are pushing a lot of bonds through the market, and also companies like SpaceX. And I think one of the big questions that investors have from a credit perspective is, what is the appropriate comp for these types of companies, right? Hyperscalers are moving from kind of an intangible soft asset type of operating environment to operating data centers, which are very capital intensive. SpaceX, a conglomeration of a lot of different types of companies. So trying to assess what credit fundamentals should look like and what they will look like over the next 1, 3, 5, 10 years has become increasingly difficult, which makes it really hard to assign appropriate relative value to pretty much anything.
Well, that's what I'm curious about, too. I know it's easy to kind of look at, certainly in the credit space, to look at how tight spreads are on an aggregate basis. And, okay, I guess that's a sign of health. Even in the equity market, there are a lot of valuation metrics that would suggest everything's okay. But you have SpaceX that not only came to market with that big IPO, but then it immediately went to the bond market for $20 billion. The speculation, though SK Hynix wouldn't confirm this, is that SK Hynix will also tap the debt market at some point. When you see folks going to the equity space like that and then almost simultaneously going to debt markets, is that a sign of health, or is that a sign that maybe we're at the top?
I think it's a sign of just the sheer amount of capital that is expected to be needed to fund the build out of AI capacity from an infrastructure, all the way through to kind of end model basis. And with that, you do have to be a bit careful about understanding, will every model ultimately be a success? Will every data center ultimately be needed at full capacity for a sustainable period of time? And I think that for right now, people are really comfortable about kind of the initial build up demand, infrastructure side of things, but the end demand is a little bit less tangible, especially as we start to hear about more companies trying to really quantify the return on AI investment that they're seeing. And so I don't want to say that it's necessarily a sign of a bubble, but anytime we see a lot of capital going into one specific thing, kind of in a relatively short period of time, we do have to start thinking about winners and losers within that cycle.
And Winnie, I'm wondering if you're seeing any signs of fatigue among investors when it comes to this supply onslaught. I mean, so much has been made of the fact that we had Amazon tap the market this week, and that deal was oversubscribed, but only by 1.6 times. That's certainly much less magnitude than when they tapped the bond market just 4 months ago. So, I mean, when you're taking a look at the reception here, do you see any worrying signals?
I would definitely say that we're seeing a little bit of a sign of fatigue. AI fatigue, I think, is kind of taking hold in a number of different areas, but especially within the primary market. I know that Amazon, a lot of people have been focused on that, and it was a little bit of a surprise that they came back to market so quickly. And also July, typically not necessarily the best time to come to market. You have kind of the summer vacation and the thinner primary demand. But we've also seen a little bit of a deceleration of demand in the high yield primary market for data center aligned deals. So it does seem, as you kind of take a step back and try to assess, are people still as positive on adding this paper to portfolios? It feels like maybe the answer is no.
Well, expand on that a little bit, Winnie, because, much of this conversation around AI, tech debt, has been about the primary market when it comes to investment grade. We don't spend as much time talking about high yield. So just compare and contrast there, what you're seeing when it comes to this debt deluge and how investors are actually embracing it or not.
Yeah, it's interesting because the high yield market, we've seen a lot of data center aligned paper come to market, and it doesn't look like traditional high yield paper. It's much more project finance oriented, and some of it is positive. It's secured paper, first lien, usually BB rated, usually with a good kind of anchor tenant story that helps ensure that once the data center is built, there's going to be some degree of cash flows associated with it. But at the same time, that kind of atypical structure is something that a lot of high yield investors have had to get up to speed on and feel how comfortable are we with these deals.
All right, Winnie. Great stuff. Winnie Cisar, Global Head of Strategy over at CreditSights, kicking us off to the close here on this Friday. We're going to continue this discussion about the financing behind the AI ecosystem, a conversation up ahead with John Medina, Senior Vice President of Global Project and Infrastructure Finance at Moody's.
Plus, we continue the tech conversation with a look at the IPO pipeline. Gary Gensler, former SEC chair and professor of the practice of global economics and management, as well as finance at the MIT Sloan School of Management.
And then we hit the links from IPOs to irons, a conversation on the growing business of golf. Chad Mumm, co-founder, president of Pro Shop, going to be joining us in a bit. Stick with us. This is The Close on Bloomberg.
Well, the biggest AI data center builders have doubled their debt load in the last 5 years, according to data compiled by Bloomberg. Our next guest warns that the rapid build-out is putting unprecedented pressure on U.S. power infrastructure. Joining us live, I'm pleased to say, is John Medina. He is Senior Vice President of Global Project and Infrastructure Finance over at Moody's Ratings. So, John, just to set the scene for us, unprecedented pressure when it comes to U.S. power infrastructure. What does that look like in practice? What are you seeing?
It means a few different things. It means that the demand that had been basically flat for about a decade is now spiking in certain areas because of new data center demand. It means that in unregulated markets like in PJM, there's an auction that happens every year. We'll get those results next week. Those are hitting the cap. A cap was put in place related to that. It also means from a grid and transmission perspective that potentially there's more congestion on some lines that maybe didn't have that before. It means where there was excess power, there probably isn't excess power anymore because that is now being utilized. So it does affect the overall grid, the supply that's coming in, and sort of the approach to managing that as well.
Well, I want to talk a little bit about the approach to managing that. And I'm wondering, if you're seeing that increasingly become more of the conversation when you think about these data center financing deals, when they're coming together, the acknowledgement that, this is increasingly an issue.
It very much is, and I think some forecasts are showing half of the new data center demand coming to market will likely be supplied by what we call behind the meter generation, essentially off grid. Bring your own power, right, to the party, essentially, because what they're seeing is the grid connection is taking 5 years, maybe 7 years in some cases, and you can build on-site power faster. And if you want to bring that, again, speed to market is the name of the game. If you can bring that to market faster, you can bring that on-site generation online faster. That helps, frankly, relieve the pressure on the utilities that you would normally go to directly to build that on a utility scale basis. So this is actually building large pockets of new generation that otherwise would not be built. And from a certain power management perspective, you can think of it as a lot of backup generation, a lot of essentially batteries are being put out. And some of the grid operators are asking to access that during times of, peak heat. We had a heat wave. You need to turn on some backup generation. It's becoming a new source as well.
I am curious about the build out and about the idea of the use cases. And there's been sort of this focus that some of these are such singular use cases, and not only just in terms of what they're building, but some of these sites are very remote, and it raises the whole question about reuse. And then there's also latency issues as well. How has that factored into your research?
Definitely use case has to do with a lot of these are for training. That's sort of one of the long-term perspectives. But because of improvements in latency technology, improvements in connectivity, sometimes location may be less important. We've seen new infrastructure built over time, for example, from Northern Virginia to Ohio. Now, lots of new data centers were built in Ohio because of that new connectivity. You'll see that continue over time in terms of connecting these two individual users like yourself and myself, which we call inference. So training is what we talk about a lot, but inference really is where you deploy all these models and use them more and more. So I think there will be more back and forth between training and inference. It's not going to be so singular as it may sound over time, particularly as the connectivity and latency issue gets solved.
And what about with regards to the mismatch between, the duration of the actual data center, the actual servers, or I should say the GPUs that go in them, relative to the build out of the grid itself? And that's been a lot of talk about the queue to actually get the grid up to the capacity needed is much longer than it takes for NVIDIA to stick something into a box and put it out there in the desert.
And that's really why you're seeing the behind the meter approach. I mean, essentially, you can build a data center these days in less than a year, but you can build, get that delivery. I think sometimes the manufacturing timeline is part of the supply chain constraint. It's either the chips or it's the power, it's the data center. Those three prongs. It's always moving back and forth as to what's sort of constraining the build out. At this particular time, power, it often takes longer to build. There is a long timeline for some of these key pieces of equipment. And so those that were able to access it early, get that in the queue early, are able to build faster and sort of match that in terms of the GPUs coming online and the power to supply them. But I believe that in terms of delivery, you can't get delivery until your data center is up and running and has power. So there's kind of a balance between those three all coming together to deliver that compute.
And John, when it comes to the power conversation, just in the minute we have left with you, I mean, you think about some of the pushback that communities have, expressed when it comes to the data center build out is, discontent when it comes to higher energy costs, higher energy bills. And, there is this perception out there that the data center operators aren't paying their fair share. And I wonder, how much that actually aligns with reality.
It's a mix. I think they're all paying their fair share in the sense of infrastructure because the utilities are requiring them to pay for their substation, requiring them to pay for any transmission line. The utilities are also requiring them to pay minimum charges, potentially letters of credit in case they were to not be there so that there's no stranded assets. So it's a combination. If you're coming into a market, like I mentioned with PJM, where there's an auction, whoever pays the most, will get that power. That can drive up power prices in that region. In other cases where it's a regulated market, prices are very much driven by the broad utility in that relationship. And I think that this behind the meter sort of, next to each other trend that we're going to keep seeing, more deals are coming to market, really helps solve for that issue, really kind of removes some of that off. But you're going to continue to see, I think, pushback, what we call, political risk because of it's a big headline. It is a lot of power, in some cases, a lot of water. But at the same time, it's also bringing new tax revenue and new support to many of those areas. I think 14 states have proposed moratoriums or delays, but many of them haven't passed or have been vetoed to date.
All right, John, got to leave it there. Great stuff. John Medina, Senior Vice President over at Moody's Ratings. When we come back, we're going to turn to the airlines. Delta shares down as investors really trying to dissect the earnings report that we got this morning. Some good, some bad. We break it all down after the break right here on The Close. Time now for our top calls, the big movers on the back of analyst recommendations. We start off with Akamai, CFRA upgrading the internet conduit company to buy, encouraged by strengthening momentum and a strong pipeline amid that AI infrastructure demand. Nevertheless, the share is down on the day. Next up, let's take a look at Seagate. Wells Fargo boosting its recommendation on the maker of hard disk drives and data storage devices to overweight. It's another AI demand story with the analysts expressing confidence, I say, confidence in the company's earnings prospects. Those shares up for a third straight day. And finally, let's take a look at Toll Brothers. Citi out with a careful call, upgrading to buy, saying the builder of higher priced homes is on the right side of the K-shaped housing market and is the only pure play stock on luxury home building. Those shares up about 1.5% on the day. And those are some of our top calls. We're also keeping an eye on Delta Airlines. The shares are down despite the airline reaffirming its full year forecast that it had already set at the start of 2026. The earnings report still shows strong demand for premium corporate and international travel. Still some of their concerns there about higher fuel costs. Joining us right now to talk about this is Tom Fitzgerald, Vice President of Equity Research over at TD Cowen, covering the airlines and the related sectors. Great to have you here, man.
Thanks so much for having me.
All right. So overall, look, we were talking like mid-teens in terms of revenue growth, passenger growth, premium growth. There was growth everywhere.
Yeah.
They kept the capacity down. I want to ask you first about fuel prices. That was up 77%. Is that just sort of a one-quarter thing, and we can expect that to go down for the next couple of quarters?
It's better, much better than we were expecting maybe 3 months ago. Yeah, and fuel actually even came in a little lighter than we modeled in 2Q. And yeah, we're normalizing much closer to where we were back in January right now.
And let's talk a little bit about airfares, because, we heard from Delta, their management saying that to expect higher fares deep into 2026. And I have to imagine, this really insulates Delta, that focus on premium, than maybe some of the issues that their peers are dealing with.
Oh, absolutely. I think they've been, within the airline industry, they're one of the big beneficiaries of the K-shaped theme playing out. And that exposure to, I have that much more confidence in them coming out of Labor Day after the summer, where you see corporate traffic really come back to the fore again. And I think that can carry them into the winter. And then if we have another good peak season next year.
How far can you go with that strategy, though? And I don't mean just in the terms of charging more for premium services. That in itself makes sense. And there are a lot of people out there that are willing to do that. But we started to see this weird sort of conglomeration of different tiers of different things. You have tiers within business class now that is kind of confusing. You don't quite always know what you're actually buying. Does that come back to maybe work against them at some point?
I don't think so. I think, that tiering within business is more common overseas. You see that some places in Europe. And I think, you can do a la carte in economy. Why not have a la carte in business? And an example would be, someone who maybe they don't want all the bells and whistles, they don't care about the lounge, but they would pay for a lie-flat seat on a red-eye flight. So you get things like that. I think it's a better way to adjust. There's fewer corporate traffic volumes, so you're going to have less close-in high-yield bookings. So this is a way for you to optimize how you're pricing your inventory and how you're adapting how you merchandise.
So we're going from the tasting menu to just like buffet style.
Yeah, be all things to all people. Renaissance Airlines.
There you go. You mentioned that not everyone wants the lounge, but some people really do want the lounge. And when it comes to that fare segmentation, do you think that they've done a good enough job sort of communicating that? If you're buying this ticket, you will get these perks, or maybe you won't get those perks.
Oh, absolutely. And I think, if you really care about the lounge, you can get this the slightly higher fare. There's other, I believe it still has access to the Sky Club lounge. You can still get lounge access through the credit card. There's a lot of different ways to get there. And you don't want the lounge is too crowded either, right? You don't want them to get the Yogi Bear and nobody goes there anymore. It's too crowded territory.
I like that, yeah. And I will say, someone who travels a lot, Delta's probably one of the more flexible and certainly way more flexible than American. But I am curious about the other airlines as well. Is this a story right now, at least when it comes to the U.S. airline industry, of just the big three? We're just going to basically, in terms of performance, both in terms of their income, balance sheet, stock, is just American, United, and Delta, and then everyone else? I think it's Delta and United out in front of everybody right now. I think American looks the most similar to those airlines, and because they have a higher leverage level, there's an interesting torque opportunity for the equity to own more of the overall business. Yeah. And then I think you see Alaska, JetBlue, and Southwest, all of them have been in their own style, but trying to go up market, trying to adapt to the new normal.
And, some of your peers on the street do see an environment where maybe you could see some mergers when it comes especially to those lower airfare type carriers. Do you think that that's, anything that could happen soon?
I don't, whether it's an outright merger or there's maybe quasi-restructurings if people shrink down their fleet or if there's stuff that has to go to core. I don't think anything's out of the question this decade with the airline industry. You've seen all the different scenarios the last 6 or 7 years. Yeah. But I do think there's certain business models that maybe aren't fit for purpose in the new normal. So I think that's got to get resolved one way or the other.
All right, Tom, great to get some time with you. Have
Thanks
a great weekend when you get
there.
there.
They got to get all these reward programs like that. I feel like it's like streaming now. I got so many. I had to become an Admiral member for this and the Delta thing for that and blah, blah. It's too much, Katie.
I did ask that lounge question for you. I had you in mind.
Yeah, thank you.
You seem like a lounge man.
I do,
Anyway, Tom Fitzgerald
of
TD Cowen joining us on Delta Earnings. And coming up next, a really exciting conversation on the heels of SK Hynix raising $26.5 billion in the biggest foreign debut in the U.S. We're going to be speaking with former SEC Chair Gary Gensler. He'll join us to talk about the listing, what's next for capital markets, and I'm also going to ask him about ETFs.
What?
This is The Close on Bloomberg.
Like everything, what we tell people is you can't market time these things to the day. You have to kind of sense changes in the second derivative, and we're sensing it. Just look at some of the news flow that you're seeing from companies like Meta. It kind of signals to you that there are conversations about the rate and speed and return on investment on some of this CapEx and how can they pull forward their monetization strategies.
Lisa Shallett over at Morgan Stanley Wealth speaking this morning. I guess what everybody's been speaking about pretty much all year long, and that's the tremendous amount of capital going into the AI space, and I guess in her view, whether or not it's actually justified.
Absolutely. Yeah. Capital, when you think about, investors funneling money in, you have companies raising money in the equity market, also big time in the bond market. Really interesting set of circumstances here, and I'm excited to talk about all of it with Gary Gensler. He is the former SEC chair. He's also a professor of the practice of global economics and management, as well as finance at the MIT Sloan School of Management. Gary Gensler, it's great to see you.
Great to be with you.
So let's talk broad strokes about the U.S. equity market, because for years, as I know you know, it had been shrinking. And now you're in this situation where IPOs are back in a big way. You have the likes of SK Hynix coming here, listing in the U.S., and you're also seeing some of these big tech companies engineer capital raises as well. So for the first time in a long time, it feels like the net supply of equity in the U.S. is growing. And, I wonder what you make of this sea change, what it says.
Well, our equity market is half the world's equity market. And as all of your guests will chat about, it has high valuations right now. And it doesn't really matter which measure you use it, whether it's the total market to our economy, that's the Warren Buffett index, or if it's price earnings ratios, past, forward, Schiller index, you name it, high valuations. And so I think that's part of why there's supply. Why did Google raise $85 billion? Why did SK Hynix raise $26 billion and see a 14% bump and SpaceX go public? These are all tells that people are saying, this is a high valuation market. I want to raise capital while I can.
And I mean, certainly you're seeing both companies and investors seize upon that moment. But you know, I want to bring in the word bubble to this conversation. You mentioned the high valuations. A pessimist would look at that.
She said bubble. Not
I said it first.
Katie,
you brought me there. You said valuations. They're very high right now. I mean, do you see any worrisome signs amid all of that, you know, enthusiasm, if you will?
Well, the actual numbers, the data would suggest we're at the highest valuations that we've been in a very long time. But also history tells us when we look at this transformation of an economy through artificial intelligence and the investments going in, pick your favorite general purpose technology over 200 years. You can start, Kitty, if you like canals or railroads or electricity or the internet. You love it all. What happens? If you look at the last 10, you usually have this big enthusiastic financial market support. We Americans have a great capital market, but then we usually overinvest, and then valuations come down, and we often either have a recession or even worse. I mean, that 1870s thing after the railroad boom was terrible, and the 1930s as well, as you know. So that's really the question, and it's human nature. Companies will pile in. They need to. Google needs to invest versus OpenAI or Meta. Mark Zuckerberg is saying, no, I have to. They, of course, Facebook and Google want to protect their advertising revenues, and they don't want somebody else to get in there. But think about this. SK Hynix is competing with Micron and Samsung. They do that big capital raise today. Right. Well, they right now have tremendous pricing power. They can charge almost anything for their high bandwidth memory chips. 2 or 3 years from now, that's questionable.
Well, that's what a lot of people are asking about, and we can take SK Hynix, not to just pick on them, but I mean, as recently as 2023, I mean, they were basically shrinking, more or less. I mean, they had basically negative EBITDA. They weren't really profitable. They were selling chips for less than what they made them. And now they're selling them for, multiple times of what they make them. Does it bother you at all, as a former regulator, about a company like this coming in under an ADR structure rather than a more formal listing where there would maybe be a little bit more oversight of their books?
It doesn't, Romaine. I think that the U.S. capital markets benefit from those foreign issuers. We worked when I was in the Biden administration to see if we could get the Chinese issuers, Alibaba and others.
A lot of them. And you guys had some issues.
We did have issues, but the Chinese authorities ultimately signed a 50-page agreement and have lived by it since then. It was about accounting. I think it's good for the U.S. markets to have those companies. And of course, we have the world's largest fabrication lab in TSMC, Taiwanese company, here in the U.S., in a similar structure, these ADR structures. I think that's all right. I think the question really is now the valuations, the investors, the risks. But they've put out those material risks. I read that S1, the document in preparation.
You did, of course you did, yeah. I mean.
Well, because you guys keep me, honest. And they have a lot of risk disclosures in there.
I do want to say, on that risk disclosures, and I think what a lot of people feel like in this market could potentially be signs of a top. We've gotten through the first half of the year. We got, obviously the biggest IPO ever. There's a lot more in the pipeline here. When you look at just the health of financial markets, and by health, I'm really talking about liquidity and stability, do you see the potential to absorb more of this in the relatively seamless fashion that we absorbed what we did in the first half of the year?
I think there's a valuation question. And will the market stay open? You know, Anthropic and OpenAI want to come into this market. Will they stay open? And there's also huge international flows that are still pouring into the U.S. market. And those international flows might at some point say, you know, I'm not as confident in investing in dollar assets. So that could pull off. And then, of course, the retail public as well. Where do they come? So I think the net flows have helped boost the market. And this AI trade, if it is Katie's bubble, and I think there's a lot of tells that we're testing the top. You know, just what happens if the data center space just doesn't grow next year, just stays flat.
Right.
And by the way, all of those companies right now are raising their charges for using AI. And a lot of companies in America are starting to say, you know, I might want to buy my AI inference, my data center, you know, prompts, not from a higher priced Anthropic or OpenAI. I might do it from DeepSeek, a China alternative. And I think that competition with China and what's called open weight models will also, they might lose some pricing power.
Right. And I mean, you also touch on certainly a big existential worry out there that we're in the midst of a massive overbuild when it comes to data centers. But I've restrained myself long enough. I want to talk about ETFs because we're talking about SK Hynix, that U.S. listing. I mean, you think about what's been happening in the South Korean markets when it comes to some of these leveraged single stock vehicles, fueling a ton of volatility. I remember covering the launch of leveraged single stock ETFs in the U.S. in 2022, pretty much exactly 4 years ago. And at the time, you said that these types of funds present particular risk within days of them actually launching. This space has absolutely mushroomed since then. Single stock ETFs have taken on a life of their own. And I wonder, in your view, if you see any signs that, you know, the tail could be wagging the dog here when you think about the impact of these products on the actual market itself.
Look, individuals want to have a better future. They invest in the markets to have that better future. But what you're talking about is actually borrowing money to buy the stocks. Now, inside of those exchange-traded funds, you use the word leverage. There is leverage. They're borrowing inside of that to, and in an upward sloping market, most investors will do all right. They're very costly products, by the way, because they have to rebalance every day for technical reasons. In a flat market, they actually trade off because of the high costs. And in a down market, because there's a lot of borrowing, they cut steep. They're really, so they're buying stock on margin.
Right.
And sometimes high margin.
Yeah. And I mean, the current SEC, the present SEC, is sort of grappling with how basically to regulate this growing market of ETFs in general. And it's not just, you know, single stock ETFs. You see filings for prediction market ETFs, a lot of issuers pushing the boundaries here. Bloomberg reported a couple of weeks ago that the SEC is wondering whether or not, you know, issuers should be able to file confidentially rather than having those applications out in the public on Edgar. Also thinking about whether there should be additional circumstances where the SEC could suspend the effectiveness of an ETF or intervene, basically. And, you know, I wonder what you make of that, some of those proposals, because the ETF market really feels like it's taken on a life of its own.
Well, so here, exchange-traded funds and index investing is something like 30% of our U.S. stock market. We're $20 to $25 trillion. I generally think that's a good thing. As Jack Bogle, who founded Vanguard, said, why try to pick the needle when you can buy the whole haystack and at low cost? I think the trickier thing is if you put margin into it, the leverage ETFs start to be very costly and risky. And now you say prediction markets. My friend, right now you can go on Polymarket. I looked earlier today, and you can trade on whether the U.S. government will actually confirm there are aliens by December of this year.
Could happen.
And by the way, it's trading at 8 cents on the dollar, an 8% chance. I mean, I don't know if you're going to put that in an exchange-traded fund. That seems like entertainment to me.
People are certainly trying, though.
Well, this gets to an idea, though, too. I mean, and just maybe kind of dovetailing deeper into prediction markets, and you've obviously raised some objections to some of the current way that we're overseeing this, or maybe not overseeing.
Well,
it.
and particularly sports betting. I think sports betting is overseen by the states, not.
Well, not according to some of the more recent missives out of Washington.
I understand, but I think that Congress knew what they were doing in 2010, and Congress did not move the authority over sports betting, sports gambling to the small federal agency I was proud to chair. Harry Reid, who was the majority leader of the U.S. Senate, is from Nevada.
Right. Yeah.
He had been the chair of the Nevada Gaming Commission, by the way, before he was in U.S. Congress. He would have thrown me out of his office if we were doing that.
I mean, I know you don't want to talk too much about kind of your old agencies, but I mean, we're kind of in this sort of single commissioner structure with agencies that were supposed to be a little bit more diverse, or a little bit more balanced, I should say, in the way that we're appointing CFTC, SEC, et cetera here. Is that the real story here in terms of why we're seeing an allowance of some of this stuff? Or is there an argument to be made in allowing it that it can be done safely and responsibly, even if you don't necessarily like it?
Okay, I think there's two things. One is we've taken a step away from independent regulatory agencies. The U.S. Supreme Court just ruled a week ago and said, no more, the president can replace all of those agency officials in so-called a unitary executive. Okay, we've changed that. I think that's a step backwards. I think the U.S. benefited from an independent Federal Trade Commission, an independent Federal Reserve, an independent SEC. The other thing you're asking is, why is there this support and interest in prediction markets? Partly the public likes to bet and gamble on sports. 70 or 80% of prediction markets are betting on sports. And DraftKings and FanDuel were there. But look, maybe another thing is this particular administration wants to have it in Washington rather than in the states, and it's a tug and a push and back. I just don't think that's what Congress did, and they should go to Congress and ask Congress for that, but instead they're trying to pull it from the states.
And Gary, we have just over a minute left with you, and before we let you go, I do want to zoom out a little bit and just talk a little bit more about some of the financial products that are coming to market, and not just ETFs, but I think about FINRA, for example, a few years ago, considering whether or not there basically should be safeguards to protect investors. And the U.S. has classically operated under a disclosure-based system. You just have to present all the risks associated with your fund.
The material risks.
Exactly. But I wonder whether or not you think in this current market a disclosure-based system still goes far enough.
I think if there's proper disclosure, material disclosure, the basic bargain is the American public gets to decide what they want to invest in or even bet on. I think that's the right way, but I would keep it quarterly reporting. I think this potential move to say, well, let's not do it quarterly, let's do it just twice a year, that would take something away, and the markets would be more volatile. Capital would be more costly, I think, actually, and there's academic research that shows that. And your journalist would have less to report on.
I know.
Gary, always a pleasure. A great conversation here with Gary Gensler, of course, former chair of the SEC, the CFTC, and now professor of finance at the MIT Sloan School of Management. He's got a great podcast as well out there with Nobel laureate Simon Johnson. When we come back, we're going to continue counting you down to the closing bells. A mixed, if not muted, day on Wall Street here on this Friday afternoon. Jeffrey Sherman over at DoubleLine Capital. He's going to be joining us after the break right here on Bloomberg.
People are really comfortable about kind of the initial build-up demand, infrastructure side of things, but the end demand is a little bit less tangible, especially as we start to hear about more companies trying to really quantify the return on AI investment that they're seeing. And so I don't want to say that it's necessarily a sign of a bubble, but anytime we see a lot of capital going into one specific thing, kind of in a relatively short period of time, we do have to start thinking about winners and losers within that cycle.
Winnie, Cisar over at CreditSights kicked us off to the close just about 50 minutes ago. As we head towards the closing bells, volume considerably lighter here on this summer Friday. Is it summer yet? Or
it is absolutely.
Still, all right, so summer Friday afternoon, but green on the screen on the day, and it looks like that's going to be good enough for a weekly gain for most of the major indices.
Yeah, absolutely. You can see the S&P 500 marching higher into the close, now higher by about 0.5%. I put the Philadelphia Semiconductor Index up there, only higher by about 0.2%. We're all focused on SK Hynix, of course, that U.S. listing here, but a pretty muted day when it comes to the stocks. Brent, you know, it's pretty quiet all around, and you could say the same for the bond market right now. Yeah,
seeing a little bit more of a subdued trade when it comes to oil, though it still is up about 5% on a weekly basis, and also a little bit of a die down in activity in debt markets with yields, at least on the shorter end of the curve, up about 2 basis points. Jeffrey Sherman, he joins us right now, portfolio manager of the DoubleLine Flexible Income Fund and DoubleLine's Deputy Chief Investment Officer. And Jeff, I do want to ask a little bit about kind of the macro picture, given that we all kind of had this little bit of a shock when it came to the situation in Iran, and we saw that spike in oil prices, and then we kind of saw that moderate just a bit. But it did raise some questions about where we are right now with regards to stability on the inflation front and stability with regards to interest rates.
Yeah, I mean, they're tied together most definitely. And what we've seen with the inflation front is like we continue to see some pressures building up, and that's on the core side. And what you saw from the ISM data that came out earlier in the month, both manufacturing and services can continue to have these expansionary readings. But the downside, when you dig through the report, is the prices paid underneath that are showing pretty elevated levels. And so you're continuing to see pressure come through the inflation channels, both manufacturing and services. And next week, we obviously get the CPI reports. I'm also interested to see what the PPI report shows us too, because that's been a really good indicator of where that in demand shows up in the CPI print. So I think that the Fed chairman has a tough job ahead of him. Yeah. I know he's committed to fighting the inflation, but unfortunately, a lot of this is out of his control right now. Well, good news is at least oil's down a little bit.
Well, I'm glad you brought up the CPI and PPI, because when, at least based on the Bloomberg survey of economists, we're looking at a CPI number that's going to be either flat to trending down on a month-to-month, year-over-year basis. But when you look at the PPI numbers, it's a totally different story. You're talking about an acceleration and on a couple of metrics back above 5% on core PPI. Is there a sense here that the AI build out and some of those inflationary pressures, and I know they have smaller weightings in these readings, is that starting to maybe have a bigger impact that maybe hasn't necessarily been reflected in some of earlier inflation expectations?
Well, I think it's undeniable that this part of the CapEx cycle is inflationary. I mean, we're talking about chip demand, compute demand, memory demand. I mean, look at all the headlines about memory makers in the last couple of months as well. And so these are input costs, and storage is an issue. We know power and water also as well. So as you put it all together, I think that you're going to see some of this inflationary pressure come from the CapEx build out. Now, I know the chairman and others are saying, well, AI will ultimately be somewhat deflationary or disinflationary over time. But when you have this rampant amount and everybody crowding into the same area and the demand for that, just think about like our commodity boom and things we had during the pandemic when we had a supply shortage. So it's the same thing here, but this is a self-inflicted supply shortage as everybody's piling into the same build out when it comes to technology today.
Let's also talk about, that build out in the bond market too, because again, we've been all talking about that Amazon deal this week, oversubscribed, but certainly cooler appetite than when Amazon tapped the market just 4 months ago. And it has been pointed out that they're tapping the market in July, and it's very much the depths of summer. But I mean, were there any takeaways from you there to, investor appetite and willingness to sort of absorb all this debt that we're seeing?
Well, I think Amazon is one that's probably less controversial than others who haven't really established themselves in the space. And I mean, look at the SpaceX bond offering since its offering 2 weeks ago, and specifically the longer dated debt has traded somewhat poorly. And so I think there are concerns on investors' minds about it. But, we're not talking about huge moves in terms of the yield spreads out there at this stage. But ultimately, if we're going to talk about this AI boom, a lot of it has to get financed to the debt market, and the debt market will be the clearing price. And so I don't think that there's signs of trouble today, but I think you're going to see more and more pressure. And I heard the lead out of here from Winnie saying, when you have this massive CapEx build out, there's going to be winners and losers. And I don't know if Amazon will be a winner or loser in the AI race, but they obviously have a very large business that can help support this build out as well. And I think that's what you're going to see, the differentiation in players between the certain level hyperscalers and those secondary and tertiary players that are solely reliant on this side of the business. And I think that's going to be really what the questions will be over the next 6 to 12 months.
Right. Well, absolutely. It's going to be fascinating to watch that develop. I did want to get your thoughts on another piece of news that we had out from the Federal Reserve this week. The Fed naming leadership for 5 of those new task forces that Kevin Warsh had communicated at his first meeting. And I mean, as an investor, from the investor's perspective, I want to know, how you read through some of these names and, how it sort of informs how you're going to be looking at the future of Fed policy.
Yeah, well, I think first of all, when you look at the membership there, a lot of people have AI and technology background. So I think that is something that the Fed is really concerned with and thinking through. But at the end of the day, we have a new regime. There's going to be policy changes, and we're going to, as market participants, have to learn what the Fed's going to also look at as well. And so this isn't anything new. Remember, Chairman Powell brought out a measure called super core along the cycle of a way of trying to look through inflation data as well. So I think market participants will adapt, and it's just too early to tell. But I mean, it is a who's who of the list, and so they have some very qualified folks, and we'll see what the results of these task force ultimately becomes.
All right, Jeff, always a pleasure. Jeff Sherman, portfolio manager over at DoubleLine, Chief Investment Officer there, as we count you down to the closing bells here, Katie, on this Friday afternoon, up fractionally across the board. The Russell 2000, though, is in the red.
Absolutely. And at least when it comes to the S&P 500, you are seeing that sort of good breath reassert itself. You have more than 300 names in the S&P 500 in the green right now. And you have a lot of tech participation as well, even though it's sort of a muted day when it comes to a lot of those chip names.
Absolutely. SK Hynix still getting a pretty strong bid, up about 13 to 14% as we head towards these closing bells with our global simulcast that starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell. It's a global simulcast. Carol Massar joins us now. Isabel Lee in today for Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube. A relatively muted end to what is still, Carol Massar, going to be an up week, but I was taking a look, well, don't take a look actually at some of these trading volumes because they are, is anybody working today?
It doesn't feel that way. We kept saying, it feels like stocks are crawling to the close today, just up a hair, but we're holding on to our best levels of the day as we go into the weekend, so maybe that's a plus, I don't know.
And when Carol said it, I said, so am I. I'm also just crawling through the week. We have one more hour to go, but then I want to bring this note by Capital Economics. They said that the S&P has held up reasonably well despite a correction in semiconductor stocks, but then they don't think that it will hold up to the 10% rally they're forecasting if semiconductor stocks don't join in. So again, it's really all about those semi chips.
Yeah, well, speaking of semiconductors, you take a look at the Philadelphia Semiconductor Index today. Pretty
Is it up like
quiet.
10%? Or?
It's up about 0.1%, if that counts, which is pretty interesting. Its smallest move in quite a while. So muted interest when it comes to some of these chip makers in the U.S., though I will say there was a lot of interest around SK Hynix, obviously.
Yeah, and I mean, that's a good point, too. We talk about the volatility that we see around these chip names, and let's face it, I mean, the last few days, just this week alone, the previous 4 days, you had moves of 2, 3, 4% up or down on the Philadelphia Semiconductor Index, which has kind of become standard for it. So to see only a 0.1% move, maybe some of that was, of course, some of the wind getting sucked out by SK Hynix, which looks like it's going to finish the day higher by 13%. Volume is low. Average volume at this time on the S&P versus the last 20 days, lower by 32%. But the S&P still finishes higher on the day and in the week, a gain of about 32 points or 0.4%. The Dow adding about 150 points or 0.3%. The NASDAQ Composite and the NASDAQ 100 each up about 0.3%. And the S&P mid caps Dow Transports and the Russell 2000 all finishing the day in the red. The Russell down 0.5 percentage point.
All right, guys, let's go back to the S&P 500 like I like to do. 338 names, Katie, in the S&P 500 higher today, 163 to the downside, 2 unchanged.
And let's take a look at this circle here. It was almost a perfect score, almost. You have 10 of 11 sectors in the green right now, led by materials, actually, your biggest gainer on the day, higher by about 1.1%, followed by communication services, consumer staples. The list goes on. It was a great day. What didn't have a great day, though, was healthcare, down by about 0.8% as a sector. A lot of those losses coming back to Eli Lilly shares.
Healthcare being a pooper, huh?
Yeah, there you go.
Come on, just turn green. We asked for so little. All right, let's go back to SK Hynix. We have to because it's what'd you say?
Never mind. Go ahead.
All right.
You got gainers today?
Huh?
Do you have gainers today?
I do. Okay. Starting with SK Hynix, up 28% at its highs today, finishing with a gain of about 13%. We know the ADRs. We've been talking about it all week long, looking forward to its U.S. listing. It was the largest ever U.S. listing by a foreign company, $26.5 billion raised in that ADR offering. They did trade at a premium over the closing price of the sole listed common stock due to restrictions on exchanging the South Korean stock for the U.S. instruments. There's stuff that goes on, but it'll be interesting to see the momentum. Memory, it's all about memory chip makers at this point.
Yeah.
Right? The memory guys.
And did you listen to the interview? I mean, he talked a lot about, what was it, memory as a service or something? They're just making up stuff now. Is that what happened?
Well, Mandeep Singh, who was on, he thought, they were very measured in terms of their expectations, but the demand, they seem to say, is still there and will be for several years. So, all right, we will see. Time will tell on this one. I'm going to go over to Meta Platforms, top gainer in the S&P and the NASDAQ 100.
Yeah,
this
they
one,
did well.
They did do well.
And why?
You want to know why?
Yeah.
Yes, don't leave us waiting.
Okay. Tick, 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 tick. KeyBank Capital Markets analyst Justin Patterson raised the target on Meta to $790 from $760 a share. As you can see, the stock closing at $669 and change. Writing, there are 3 things you need to build: a true frontier model, data, talent, and compute. And they believe Meta is the only hyperscaler NeoLab on track to be a world class at all 3, and therefore has the best chance of catching up with Anthropic and OpenAI. Yeah. Actually, I think this was a different analyst who actually wrote it. I think this was Semi-Analysis wrote in a note. But anyway, some optimism.
Semi-analysis, yeah.
Okay. Oh, I'm so glad you're here. You're keeping me honest. There's more there too, but
that's the only reason they pair us up. They're just like, Carol needs somebody. So.
Oh my gosh.
Jeez Louise.
I'm just here for fun.
It's like being around my 4 brothers. Okay, so for something different, let's see if Romaine can interrupt me on this one. WD-40 up almost 25% at its highs, finishing the day with about a 10% gain. You know what they do, lubricant sprays and all that good stuff. Boosted its net sales forecast for the full year. Jeffrey's weighing in and saying that while sales are to move higher, higher costs are likely to squeeze margins. So maybe a little bit of a caveat, but nonetheless, big gainer in today's session. I am done. It is all yours. Get ready for Romaine.
I am ready. So we're going to talk about the losers or the decliners. Loser sounds harsh. So Datadog, tickers DDOG, shares are down by more than 4%. This is the lowest since, July 7, 2026, but the most since June 3. So this comes after Bernstein downgraded the software company to market perform from outperform. So the analyst there is cautious about their earnings prospects going forward. And he says not only do we start lapping tough comps in Q4, but we're also seeing demand signals flatlining. So I don't know if I've heard lapping tough comps in that context ever, but definitely not good news for the stock. Up next, we're going to look at CrowdStrike. So I don't know why I chose this. The stock is down, though, by nearly 6% because the only news there is the president and CEO, George Kurtz, reporting a series of insider stock transactions. And I want to just reiterate, even if maybe our viewers may know this, that selling 3.86 million of shares. It doesn't necessarily mean a company is in trouble.
We never like to see insiders sell, but sometimes they do because they're supposed to. They have plans, right?
Yeah, I mean, I had to look it up to make sure, but it could be just them diversifying their personal wealth or paying for taxes, etc. Anyway, so market also didn't like that, down by 6%. And lastly, we're looking at Palo Alto Networks. So Needham raised their target to 425 from 350. They maintained their buy rating, but we still see the stock down by nearly 4%.
All right, let's take a quick look at yields. You did see a modest sell-off in that space with yields on the shorter end of the curve, primarily the 2-year yield, we should point out, up. That includes on a weekly basis as well. Your 10-year yield was basically, we'll just call it unchanged on the day, though we should say that pretty much across the curve, we did see yields higher on this Friday than where they were one Friday ago. Carol?
All right, guys, it's pretty steamy outside. We know we've had a lot of hot weather. We've seen hot weather records broken again, certainly around the world. Well, this New York Times story definitely caught our attention. So with changing climate change wreaking havoc on, I guess, what we normally feel like are manageable seasons, we've got some people with means, check this out, equipping their homes and even their yachts with indoor winter wonderlands, aided by companies like the Italian snowmaker Techno Alpine. They blast snow onto ski mountains, but it's a snow room. It's more or less, Isabel, the opposite of a sauna.
So I'm sorry, so you have this on your yacht, right, Carol? So what exactly is the point?
It's just so hot out there that people who have the means to do so are creating these rooms.
Like indoor snow globes?
Yes. Yes, exactly.
So instead of air conditioning, or what?
The description is it's a cave-like space of ice and snow. In some, white flakes descend gently from the ceiling to create the feeling of being inside a snow globe. I've never been inside a snow globe.
It is for those
Sounds very
who...
single purpose.
Can you convert to a sauna, I wonder, Make it
does it change with the seasons? Now, it'd be cool if it was if like a little globe, adjusted with the seasons.
No, you have to install a sauna.
Like biodome.
To have a snow room, you need to have a house, though, it sounds like.
Okay, but not everybody wants a house anymore, do they?
Apparently, Americans under 40 are questioning the value of
Did you ever see
buying
Biodome with Pauly Shore? Remember
yes,
that
we do, Biodome. I do.
All right.
Anyway, Katie, take it away.
All right, Katie, take it away.
Apparently, less than a quarter of Americans aged 18 to 39 say buying a home is a very good investment, compared with 38% of those over 60-year-olds. Basically, Bloomberg has this great story out talking about how the Americans under 40 are wondering whether or not it's even worth it to try buying a home. And I feel like, Romaine, you picked this to torture me.
Well, yeah, I mean, not that this has any sort of direct correlation to your life, but I mean, I also feel like when I read it, I kind of chuckled too, because I feel like every generation kind of goes through this. I mean, buying a home is such a weird thing because, look, long term, or even short term, it's not always the best financial decision, but we don't necessarily just buy homes for the financial return. There's obviously a lot more that gets packed into that.
Emotional return.
But even when we talk about the accessibility, it's the same thing, having to decide the neighborhood that you can afford and the space that you can afford and things like that, particularly in a high area place like New York City or San Francisco. Yeah.
It's expensive.
Yeah.
It's super expensive.
But then you have Carol, who has 3 yachts, 2 homes. And
snow rooms,
snow
rooms.
Yeah.
No, I don't.
You could have just moved into her snow room.
No, but I think what's interesting is that you do have generations.
How many square feet is that? Because in this city, you could probably get $4,000 a month for that.
That's true.
Carol, invite us, please. Romaine and I and Katie are dying to be invited.
Only Finley's I'm only gonna invite Finley, our producer.
Can
I just tell you that?
She's scared.
No, I'm not scared. You don't scare me. All right, that is a wrap, guys. Stay cool on the week. Good luck, Katie, with all your house stuff.
Thank you.
All right, that is a wrap. Our cross-platform, radio, TV, YouTube, Bloomberg Originals. We do call it the closing bell. We are not in a snow globe, though. Katie and Romaine continuing there on TV, and Isabel and I back here on Bloomberg Business Week Daily on Bloomberg Radio. Have a great weekend, everyone. We'll see you on Monday.
And a lot more coming up here on The Close. There is a new earnings season about to kick off in just a couple of days. Finley Walker, unfortunately, won't be here for that. But for the rest of you, stick around. There'll be a full breakdown of everything to expect when we come back after the break, right here on The Close, right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostick. A relatively muted day on Wall Street. Volume across the tapes down more than 25%, as I guess a lot of folks took off this Friday. That wasn't enough to restrain all of the markets, though, with the S&P, the NASDAQ, and most of the indices closing higher on the day and on the week. Now, one exception was the Russell 2000. For all of the talk we've had about the year-to-date outperformance by the small caps, not only were they down on the day, but they actually had their second straight weekly decline, the first time that's happened since early to mid-March. The KBW Bank Index up for the day, but down on the week. And a modest reprieve here on Brent crude on the day, trading right around $76 a barrel, but we're still up about 5% from where we were about a week ago.
Absolutely. Well, let's take a look at some of the individual movers on the equity side. And I wanted to start with NVIDIA. Of course, this was one of your big points contributor to the upside when it comes to the S&P 500, rising about 4%. But that looks pedestrian compared to what we saw in SK Hynix, biggest foreign listing in the U.S. ever. Those ADRs rising about 13%. And wanted to highlight Meta one more time. Actually, Meta finishing the past 2 days, rising over the past 2 days by 11%. That is the most since 2025. So a great week for Meta shares. But let's get to our top story this hour, and that is investors ready for an earnings flood. The largest U.S. bank set to report next week, with 5 of the 6 due to post on Tuesday alone. Now, the largest lenders, with a combined market value of more than $2 trillion, expected to show their second best stock trading revenue ever, Romaine.
Absolutely here, and really the key day is actually going to be on July 14th, where we get Goldman, Bank of America, JP Morgan, Wells Fargo, Citigroup, and then the next day we get a whole other slew of banks as well. Macrae Sykes joins us right now, portfolio manager at the Gabelli Funds, who covers some of the big diversified banks. And Macrae, I do want to start off with this idea of sort of what the trading side for these banks. So let's just take JP Morgan, Morgan Stanley, Bank of America, and I guess to a smaller extent Wells. Is this just going to be a phenomenal quarter across the board because of the market volatility that we saw over the past 3 months?
Yeah, I think that's right. Some of the Goldman Sachs is more sensitive, in terms of their component of revenue related to markets and IB. But as you go down that waterfall, the results are going to be pretty exceptional. And you're looking at earnings gains year over year for some of those major banks, Morgan, Bank of America, et cetera, of over 30%. We had a quite exceptional IPO issuance, led by SpaceX, and just this half year was more raised than the entire 25. So a lot got done in this quarter, and we're off to a good start with SK Hynix there for the second half as well.
I know it's easy to kind of look at capital markets, and we know trading's going to probably be good, as you just kind of alluded to. Investment banking side is going to be good. What does loan growth sort of look like? What are your expectations, not only for what we saw in the most recent quarter, but the type of guidance we may get from some of these banks as to how that plays out for the rest of the year?
Yeah, so there are a couple components to that. I would just say on the kind of the commercial banking side, we've seen steady, slow growth there, so 1% to 2% deposits, loans. There'll be some puts and takes with some of those different banks in terms of where they're seeing that growth and the deposit gathering, et cetera. So we'll probably get an update there, and then there's going to be some movement in the NIM and the expectations now that we're halfway through the year. And as we know, the Fed expectations have flipped from 2 rate cuts to start the year to potentially 2 rate cuts at the back end of the year. So we'll have to see on that, and we'll get some more feedback. But overall, NIM's fairly stable, growing or getting better, and then you have the loan balances there. So that's the commercial side. Now on the market side, certainly more engagement there, prime brokerage, et cetera. And then on the wealth side, we expect to see margin loans increase, with the higher market levels and engagement there. So that will help boost the wealth and fee revenue.
Yeah, absolutely. And I do want to get your thoughts, Macrae, on where we are when it comes to the private credit story, because we had seen that sort of as an overhang earlier in the year in previous quarters in some of these bank earnings. Where are we now?
Right. It's really tough to dissect. I think in my interactions with some of the management teams, the major alternatives firms and further commentary this quarter, there's still some challenges with respect to figuring out what's going to happen with AI and some of those portfolio companies and the credits in terms of those leverage. So that will be worked out. But what I hear is that, the realizations continue. They are gathering assets in the wealth channel. And then institutions have really stepped up to the private credit area as well. That's across a number of different asset classes within that. So the demand on the institutional side, continues. There are some hot pockets, of weakness in terms of some of those underlying credits, et cetera. But again, this is, just a smaller part of the whole credit spectrum So, impacting a few firms, but not overall in terms of impacting the overall market.
Absolutely. Well, when you think about just the wave that we're surfing into next week, an embarrassment of riches when it comes to bank earnings, I wonder, in the stable that you own when it comes to these big banks, who are you most interested to hear from at this juncture when you take a look through your portfolio?
Well, I think there's one sort of peak aspect to this. This is an exceptional quarter for markets, IPO issuance. We'll have to see how the momentum continues in the second half. But we continue to like Wells Fargo. It's been a laggard here. A group that's up over 10% and it's down 7% year to date. They have an improving ROE and they've come off this asset cap, so they're re-optimizing their balance sheet and growing lending growth. So a little less sensitivity to markets, but a good wealth management division, 10% of their profits, so they'll benefit this quarter from that. And management pretty focused on streamlining the business. And 1.6 times our forward 27 estimate of tangible book. We think that's value among sort of the more richly priced banks here, even though they're all fundamentally doing well.
I do just want to get your thoughts here, Macrae, on the leadership of a couple of the big banks. Obviously, there's been a lot of speculation about succession at J.P. Morgan, given the departure of Marianne Lake and the elevation of a couple of others. Also, a lot of speculation around Bank of America as well. I know it's unlikely that we're going to hear about this specifically on this earnings days coming up next week. But I'm sure there are some analysts out there that are going to sort of pepper them with questions. And I just want to get your thoughts here as to what you're comfortable with right now. I mean, no one's going to sort of, impeach Jamie Dimon's a success that he's had. But when you start to look at his age, you want to see that there is someone there who can actually pick up the baton and fill his shoes.
Yeah, that's fair. And I think he recognizes that. And, you saw some moves a couple of weeks ago where, the two officers were elevated, and internally they're the forerunners for the position. And then Marianne Lake was a very good executive. We saw her depart. So that's a little bit of uncertainty there. But at the same time, you're having two people that are pretty focused that can step in for Jamie. He's made it very clear that he still has a short amount of tenure at the firm, and so I don't think that's going to change in the immediate interim. And he's talked about 3 years, and then he's going to continue to be the chairman. So his influence is still going to be there for many years, even though you may have a change in the CEO role. And then they have a really deep bench there. So I think even though you had some shuffling there and probably some disappointment around Marianne, this is still a very solid bench with pretty good transparency as to the ascension and what's going to happen going forward with those roles. So I wouldn't get too worried about it, but I expect a bunch of questions around it on the conference call for sure.
Yeah, absolutely. Well, Macrae, that's a good place to leave it. Appreciate your time on this Friday. That is Macrae Sykes. He is a portfolio manager over at Gabelli Funds. Now, coming up, the U.S. listing of SK Hynix wrapping up its first day of trading as the CEO warns memory chip shortages will last into the next decade. We'll break it all down next. This is The Close on Bloomberg.
The SK already invested in more than $35 billion in U.S. side. My plan is that much bigger number. So, bigger than 35, yeah, well, much bigger than 35.
And that was the chair of the SK Group speaking earlier today with Bloomberg's Ed Ludlow promising to invest more money in the U.S. And this as the CEO of SK Hynix warns of a memory crunch to last into the next decade. To break down all the actions, all the headlines, we're joined now by Ed Ludlow. He, of course, is the host of Bloomberg Tech. He's still in New York. Ed, it's great to see you.
Good to see you.
So what a day. SK Hynix, of course, officially starting trading today. Big debut on U.S. markets here. When you think about those comments from the CEO, I guess, that would be a great situation for SK Hynix if we saw these shortages last into the next decade.
Yeah, I mean, clearly there was demand from US investors to get exposure to SK, right? But it's a balancing act for them. The investors want to see them continue on the path they've been, 80% margins. And the customers want them to spend a lot of money to expand capacity. And, part of the pledge from Chairman Chang, however big that number is in the United States, raising $26.5 billion for a first-time U.S. share sale, it's nothing, really. They are on the hook for hundreds of billions of dollars, both domestically and Korea. and in aggregate here in the US and around the world. So they'll come back to the capital markets for sure.
I am curious, though, about this idea of expanding capacity, because right now, the lack of capacity obviously benefits them.
Right.
And we all know historically, just the chip cycle, particularly in memory chips, was a cycle. Partly because of this capacity issue. They would overbuild capacity, then prices would plunge, then they would correct, and then rinse and repeat. It seems like a time where they could finally get off that hamster wheel, unless they are so confident that the demand long-term is going to be there. When you spoke to him, did you get that sense, or did he articulate that he is confident that that demand will be there long-term?
He articulated it succinctly. Demand, he thinks, will actually increase, and he explicitly said there is a world where supply never catches up with it. They never, ever. They never get their supply. You know, and again, you are exactly right. They are talking their book to their advantage.
I get that, but when we talk about these investments, obviously they're making investments in Korea, but also here in the U.S., not necessarily just SK, but Micron and TSM and all this. And then you're looking at the dates when these fabs and other things are going to be online, and we're talking 2030, 2031, and beyond. And I just kind of scratch my head. I'm like, it's 2026. Are we still going to be in an AI boom?
How can you have line of sight that far ahead, basically? I know. Well, their argument is an academic one, which is that in a world where all these data centers are finally built, we are in the inference phase running the AI workloads, it makes the memory demand all the more important. The technology itself comes into play. That was the simple argument that he was making. The other thing as well is that right now the short-term supply constraint is, remember, an HBM chip is just 12 or 16 layers of DRAM. Right now there's an entire other market, consumer electronics, that's trying to get hold of the same supply. And there's that tension there. So in the interim, while the capacity isn't there, they're trying to serve all these customers and keep everyone happy.
Right. And Ed, just quickly here, I mean, this is, of course, a story about memory chips and supply crunches here, but it's also a story about capital markets as well. I know you also spoke to some executives from NASDAQ, and the hope here is that, you know, the way this was embraced, maybe it's going to encourage more of those foreign companies to come stateside.
Not just the Korean companies. Samsung was the one that I tried to get the NASDAQ talking about. But in Europe, there are lots of companies that have never gone to the public market or haven't done ADRs, and a lot of them were looking to see how this went for SK, because now they could be next. Because what they all have in common, they need money.
Okay. Oh, yeah. But do they have the attractiveness or the shiny object that you held up during your interview with SK Hynix there? I mean, I heard I heard that interview with Nelson Griggs, and I know he dodged your question.
He did.
But I mean, there's only so many SK Hynixes out there.
So the thing is, as well, there's something very specific about the functioning of the Korean markets. If you're a fund manager, not just in the US, but you're a fund manager anywhere in the world, ex-Korea, accessing that market's been hard, which was part of the function of why SK had such demand for the ADRs.
All right, Ed Ludlow, the host of BTech there, a focus there on the big debut of the ADRs of SK Hynix here in the United States. We're going to stop talking about AI and chips for a second. We're going to talk about Katie's favorite sport. Golf. The growing business of golf. We're going to catch up with Chad Mumm over at Pro Shop when we come back after the break, right here on Bloomberg. All right, we're going to talk about golf in a second. I just want to very quickly bring to the attention of our viewers a red headline crossing the Bloomberg terminal on Apple suing OpenAI. The headline is that Apple is suing OpenAI for trade secret theft. It says that Apple says its employees were encouraged to share information about its upcoming products. Now, this is a scoop by our very own reporter, Mark Gurman, and it involves litigation. So we're going to give this a little bit of time to breathe here, but that is the headline crossing the terminal. If you have a Bloomberg terminal, the full story is there online. We'll try to get you some more details on that as to exactly what this is about. And are seeing a little bit of movement in the shares of Apple. Obviously, OpenAI is still a private company. All right, we do want to turn to the world of golf because the Scottish Open kicking off, and the world's #1 golfer is actually not going to be part of it. He's heading home early after missing the cut. Actually, a rare cut miss for Scottie Scheffler. The surprise exit comes just days before golf's final major of the season, the Open Championship. And while fans won't get the behind-the-scenes stories just yet, they are going to be watching when the next season of Netflix's series Full Swing drops. Chad Mumm, he's the producer of that hit series. He's also the co-founder and of the media company ProShop. Chad, great to have you back here on the program. I do want to talk about kind of this idea. I mean, and we can kind of put this on the frame of Scottie Scheffler, of course, is the draw for a lot of folks right now. And of course, to not have him actually, make it to the weekend rounds certainly probably ends up being a hit. But when you look at the breadth of stars out there that can attract eyeballs to the telecast and to everything else in golf, are you comfortable with where we are right now in terms of the talent out there?
Yeah, it was a rare miscut for Scottie Scheffler. He had a long streak going. I felt like, he had a chance to kind of try to catch one of the great streaks in golf, which was Tiger Woods' made cut streak. But Scottie's still the #1 player in the world and a huge fan favorite all over the globe. I'm sure he'll be in fine form as we round into the Open Championship, which starts next week. But you know what? Golf just continues to boom. And we've seen historically golf's had moments where it's gotten extremely popular and the consumer adoption of golf has grown. And every one of those throughout the years, whether it's Arnold Palmer or Tiger Woods taking golf global, has largely been driven by a singular superstar. And what we're seeing now is golf growing in popularity almost without the megastar. Obviously, Scottie Scheffler, guys like Rory McIlroy, they're fan favorites, but we haven't seen that mega high wattage superstar like Tiger Woods. And yet golf continues to boom, not just around the world, but particularly in the United States. We're up to, as you saw in that graphic, according to the National Golf Foundation, 48 million Americans 6 and older playing golf in 2025. Yeah. That is massively up over the last few years.
I am curious, though, about, and it's a good point, and we talk about this idea, too, of just how this sport has gotten better at marketing. We talk about Full Swing and kind of inspiring the whole, Drive to Survive and a lot of these other series that have helped sort of promote various sports leagues. I assume you're filming your next season. I don't know if you're out at Birkdale or not, but give me a sense here as to what the storylines that you're looking for this next season.
Well, you know what? Really, we're focused always on just trying to tell the great stories of golf. And I want to actually come back to just golf's relevance and culture in general. I'm actually here in Los Angeles where we are. We just did the world premiere of The Hawk on Netflix yesterday, a production that I was involved in as a producer. Last summer, we were celebrating the launch of Happy Gilmore 2. And it just feels like golf has entered this pop culture lexicon. And obviously you see here clips from Full Swing season 4, which premiered a couple months back in April on Netflix. But, Netflix again, with a golf show launching in next week with The Hawk with Will Ferrell, you had Adam Sandler, you have Stick on Apple TV. You've just got this pop culture moment that golf is having. And it doesn't matter if it's on the small screen, with stuff like The Hawk and obviously the big screen with Happy Gilmore, or your weekend TV with, with all this, like with the British Open starting next week, or it's on the tiny screens, Instagram, you got LeBron James, you got Kevin Hart, YouTube golf is exploding. It just feels like golf's having a moment and the industry is meeting that moment right now.
Yeah, absolutely. And it's interesting when you think about this moment that golf is happening, this rise in popularity that it's seeing. A lot of this isn't necessarily happening on the course in isolation here. I mean, as you point out in your notes, you have simulators, they're increasing in popularity. Topgolf, for example, has also taken off. So it's not just, again, isolated to the traditional golf course here, Chad.
Yeah, no, and actually, we had some news on that front from a business perspective this week. The simulator company Full Swing, who provides the technology for TGL, which again is a new golf product. It's just finished its second season on ESPN. It's an indoor golf league that was founded by Tiger Woods and Rory McIlroy, and they finished their second season. Full Swing sold to Versant, who are is the cable spinout of from Comcast, NBC Universal, so they own Golf Channel. And so you see that it was a large transaction, north of $500 million. And I think it just speaks to this moment that's happening in the kind of consumer wave of golf. As I've said, golf's had its moments of popularity throughout the years, but what we're seeing on the consumer side is certainly something new and much more sticky.
Well, one thing I was curious about, because when I saw the acquisition, the deal for Full Swing, the simulator company, I kind of scratched my head as to, why would, basically a streaming network actually would be involved in that. But then I kind of thought about it, and I guess it sort of makes sense. And I do wonder, even beyond golf, if you think that is kind of the future, where we're going to start to see sort of the combination of media, the actual sport itself, and these sort of, I guess, call it products, if you will, such as a golf simulator or whatever else.
Well, I think, unlike other big sports in the United States, golf has always had this participatory angle to it. There's a lot of people who watch the NFL, obviously a lot of people who are watching the World Cup right now. not as many people go and play football. Not as many people go and play soccer, especially, you know, once you're a certain age. Golf is a game you can play your entire life. And as golf has boomed coming out of COVID, you know, there's been 19 million people who started playing golf who played exclusively off the course last year. So that is a mind-blowing amount of Americans, 19 million, almost 20 million that played off the course. That includes simulators, that includes driving ranges, that includes things like Topgolf, you know, putt-putt, like high-end putt-putt, like Putt Shack and things like that. Yeah. And so what I think you're seeing is, you know, golf's always had a very high, very valuable demographic. And if you look at the PGA Tour and their media partners and the sponsors of their tournaments, it's a great way to reach, you know, key business decision makers. But now you've had this wave of normal people, you know, kind of everyday Americans who are picking up golf, who are now obsessed. And I think the acquisition of Full Swing Simulators by Versant makes a ton of sense. You know, it was a little bit off the radar, but back in 2008, Comcast acquired a business called Golf Now, which is a tee times business. They've now bundled that with a membership program called Golf Pass, and it's kind of quietly maybe the best digital business in golf, if not one of the most profitable sort of digital businesses in sports. And I saw that acquisition, and certainly, you know, it's an eye-popping number for a golf simulator company. But when you think about the way that that NBC in its previous era and Golf Channel was able to leverage the tee times business into a digital juggernaut, you could see and start to squint a little bit about how they take the technology of a full swing simulator, which is unique among simulators in that it uses cameras to do the capture. Yeah. It's not a radar-based system. You could see how they could build a bundle around instruction, around more casual fans. I think it's a really smart acquisition, and, you know, hats off to Mark Lazarus and the team over at Versant for pulling it off.
Right, and as you point out, some precedent for a deal like this. Chad, great to get some time with you. Have a good weekend. That is Chad Mumm. He is co-founder and president of ProShop. Meanwhile, we do want to go quickly back to that breaking news, a Bloomberg scoop here that Apple is suing OpenAI for trade secret theft, accusing the company of a coordinated campaign to steal information about upcoming products. Apple saying that OpenAI encouraged its employees to share information, components, drawings, and other materials related to upcoming products to develop its own suite of devices. You can take a look at Apple shares. Not too much movement after hours, but down slightly, Romain.
And we should point out that Bloomberg did reach out to OpenAI for comment, and as of at least right now, they have not responded. We do want to go to Mark Gurman. He is the byline on the story that just crossed the Bloomberg terminal. And Mark, kind of break down here exactly what's at stake. What was the relationship between Apple and OpenAI? What is Apple saying in this lawsuit, and is their relationship still intact?
So let me just give a little bit of context here, taking a step back. In 2019, Johnny Ive, who was Apple's chief design officer, he left the company. A few years later, he got together with Sam Altman, as well as some other extremely senior design and hardware engineering executives from Apple, to form a company called I/O Products. The idea was to use the AI expertise from OpenAI and the hardware and design expertise from the former Apple executives to create this startup to develop a suite of new AI hardware products, things like smart speakers, smart glasses, etc., smart earbuds. I/O was bought last year by OpenAI for $6.5 billion. Over the past few years, prior to being part of OpenAI and after being part of OpenAI, Apple alleges that they have been doing a coordinated trade secret theft campaign to get people they're hiring from OpenAI, as well as people they're interviewing at OpenAI, to bring the company information about upcoming Apple products to help inform the development of OpenAI's upcoming AI products. And so the Apple AI relationship for ChatGPT embedded in Siri, as of now, that continues. We've reported over the last several months that Apple is looking at breaking up that relationship. But at this point, we're looking towards a multi-year sort of jury trial or legal situation between Apple and OpenAI over hardware.
Right. Well, Mark, I was going to ask, I mean, what's next? You know, what is Apple asking for here? And as you mentioned, I mean, you know, the timeline here, it seems like it's something that would be drawn out.
Yeah, this is going to be a multi-year thing, if you ask me. Apple says in its filing that in February, it contacted OpenAI asking them to stop this practice, asking them to no longer take information from former Apple employees as well as employees interviewing, but OpenAI did not respond to them, leaving them no choice but to file this lawsuit. You know, on one hand, my sense is that Apple simply wants OpenAI to stop But the bigger picture here, what Apple wants is OpenAI is already deep in the process of developing its products. It wants them to redesign their hardware without Apple proprietary information. It wants the court to create an injunction to prevent OpenAI from doing that, which is going to push the can down the road for OpenAI's ability to actually roll out these new devices, which would obviously be heavily competitive to Apple.
And just finally, Mark, you did make an attempt, I take it, to reach out to OpenAI. Have you heard back from them?
OpenAI doesn't have a comment yet. Obviously, this lawsuit just hit the wire a couple minutes ago, so they're not going to be able to comment until they're able to digest what they're being sued over.
All right, Mark Gurman there, who helps to lead our technology coverage here. A closer look at a lawsuit just now being filed out west by Apple alleging OpenAI of trade secret theft. We'll keep an eye on that story. Meanwhile, we are going to pivot back to the world of sports as the FIFA World Cup now enters into the quarterfinals, getting ready for the semifinals. A big match tomorrow between the viral favorite Norway and England. There's been a lot of talk about exactly how lucrative this event has been, not necessarily for FIFA, but for the cities actually hosting all of these matches. Joining us right now to talk a little bit more about this is Nora Wittstruck. She joins us here in Studio 2. She's Chief Analytical Officer for Governments over at S&P Global. Nora, great to see you again.
Great to see you guys.
You know, it's funny. So Bloomberg wrote a story last week. It was kind of how FIFA emerges, richer, despite, there was a lot of controversy, coming into this World Cup. And everyone's, oh, no one's going to travel here and blah, blah, blah. And now Bloomberg took a look at the numbers. And I saw that you and your folks over at S&P had done some research of your own, also seeming to suggest that a lot of the host cities are actually doing pretty well. So has this been, I guess, relatively a profitable venture for them so far by hosting these matches?
Profitable is probably a little bit strong, but it's definitely a short-term economic boost for these host cities. And if you think about the consumption taxes that are paid by people coming in to watch the games, that is very lucrative. But they're one-time revenues that the host cities are accruing to them for the tourists, the hotel taxes, the sales taxes, food taxes, all of that.
Because I was kind of fascinated about it, because when you think about the Olympics, that's always been the knock on the Olympics. It's just so capital intensive to get it up and running that the return isn't really there, and you have to find some long-term ways to make that back. But I was also looking at the cities, and I do wonder, is there a difference in the benefit that certain cities have gotten? Like, I think about New York, and I think, okay, everybody, if you're a foreigner and you're going to come to the United States, then New York's probably going to be at the top of the list.
Yeah.
I doubt Kansas City would have been, maybe not Seattle. And they're going to these places, and at least if you believe what we see on social media, spending a lot of time and I think money.
Yep. Yeah. Yep. No, it's absolutely true. So, the biggest metro area gross product is in this region, right? The northern of the host cities. The smallest is Kansas City. So if you have a lot of people come into Kansas City, the impact from that additional revenue and that economic benefit is definitely felt much more in that smaller, area in and of itself. I think the other thing you can look at is some of these entities like Los Angeles, San Francisco, where some of the games have been held, like those investments that they've made to host the FIFA games have been helpful to other types of events, like the 2026, Super Bowl that I think will be held in San Francisco, and then the 2028 Summer Olympic Games that will be in Los Angeles. So those investments that the cities are making are not going to be short-term in nature. They're going to help for those future events as well.
Absolutely. So, we're talking primarily about the U.S. here, but, we're having these games hosted in the U.S., Mexico, and Canada. So does the broad brushstroke story hold across those three different countries, or do you see
companies?
Do you see any differentiation between the regions?
Not really, I would say. I think our economists estimate that for Mexico in and of itself, the games are about a 10 basis point pickup on their, national GDP. I think in Canada, it's roughly the same because tourism comprises such a small part of their GDP. In the US, the GDP is like 30 trillion, 35 trillion. So even if there's a $40 billion pickup on the GDP because of this mega event, it really doesn't move the needle. And then you factor in the Knicks, winning the NBA, and so then there's just a whole bunch of noise in the economic data, I would say.
Yeah, absolutely. I do have to say, when it comes to these World Cup games compared to the NBA Finals with the Knicks winning it, this is a very New York-centric opinion.
Oh my gosh.
It sort of falls short.
Oh my gosh.
That felt like a much bigger deal.
Or New Jersey.
That's true. Well, it was held in New Jersey, these matches. But Nora, so overall, I mean, you add it all together. It sounds like there definitely is a boost here. But you know, from the perspective of assigning ratings to these different cities, it sounds like overall, it's not necessarily moving the needle.
No, I would say we view it as being very neutral to credit quality for these host cities. You know, there are a lot of expenses. FIFA, as people may or may not know, doesn't provide any financial support to host cities. So security, overtime costs, you know, additional subway trains that have to be run, or New Jersey Transit trains, or otherwise the transit systems that are supporting the connectivity to the stadiums.
Yeah.
All of that is done at the cost of, you know, the host cities.
Yeah, I was curious about that. We interviewed Alex Lasry, who does the New York, New Jersey Host Committee chair, and he was kind of talking about that. Like basically, the FIFA says, go out there, find some sponsorship deals on your own, and just make sure none of those sponsorships conflict with the official FIFA ones, which is kind of makes slim pickings.
Right.
And they really have to scrap. And he was basically saying that it's not even about making a profit. It's like, if we can break even, we'll be happy.
That's correct. So I think, you know, the committee for the New Jersey, the New Jersey host city of the region, it's like $430 million that might accrue to the state and local governments as a result of the games. And there's hundreds of millions that they've paid out.
One quick question. We only have about 30 seconds. I am curious, though, but none of these cities really took out a lot of like financing or things. Like in the way you do the Olympics, where you have to build stadiums, it looks like every city's using existing stadiums, existing infrastructure. I know there's been, you know, they had to make some minor upgrades here and there, but it wasn't like they had to go out and borrow a ton of money to do this.
No, that's absolutely true. I think most of the stadiums were already existing. There was maybe some investments in the couple $100 million, you know, area, but a new stadium is $1 billion. So, you know, that, you're right. That's a definite plus from that perspective.
All right, Nora, always a pleasure. Glad we could get you on. Nora Wittstruck there, Chief Analytical Officer for Governments over at S&P Global.
Now, still ahead, a look at the cutting edge of healthcare. We'll speak with ClearHealth CEO Michael Chang next. This is The Close on Bloomberg. It's time now for Next Up, where we highlight the entrepreneurs and the trendsetters moving the needle in business and the economy. Now, our next guest just launched the first prescription topical acne treatment in the U.S. built around isotretinoin. I hope I said that right. That's the same active ingredient that's used in oral Accutane. Now, it's called IsoClear, and it's a new treatment that promises tolerability and efficacy versus current topical retinoids on the market. And joining us live in studio, I'm pleased to say, is Michael Chang. He is the CEO over at ClearHealth. Michael, great to have you with us. So just give us the context here, because, you know, a lot of folks are familiar with Accutane. I mean, personally, I took Accutane. A lot of friends and family took Accutane as well. And it's quite an ordeal, I mean, to get that prescription and to take that orally. So what's the benefit of, you know, the topical treatment?
Yeah, thanks for having me, first of all. So I'll go back to the beginning with ClearHealth. We started with Accutane. Accutane is a phenomenal treatment that's been around since the 1980s. In the United States, very highly regulated. There's iPledge requirements, monthly testing requirements, pregnancy test requirements if you're a female. We're one of the first telehealths to make this a more seamless process for both patients as well as the providers and the pharmacies. And what we found is that a lot of people coming to us, they just weren't ready to take that step to go on oral Accutane. They didn't want to go on the requirements, the monthly testing requirements, and do check-ins every single month. And so topical isotretinoin, you don't have to do that. It's a topical gel system. It's not a pill. You put it on your face, so it acts locally instead of systemically. And so you don't have the same systemic side effects as oral Accutane. And we kind of view it as that step in between drugstore treatments and going on oral treatments.
I am curious, though, about, so the business model here, though. So this is, I assume, a subscription model?
Correct.
Based on that here. What is sort of the exclusivity that you have for this, and how long does that exclusivity last?
Yeah, so this is not an FDA drug product. This is a compounded product. And so it's not subject to the same testing requirements, the patent requirements of a pharmaceutical drug. That being said, it's the first time that this is being introduced in this format. And so there's not...
but you're the first mover in this,
We are the first mover in this.
But if somebody decides tomorrow they want to set up a website and start to do the same thing, how do you differentiate yourself from them?
Absolutely. So the moat question, we kind of break this down.
I was trying to avoid using the word moat, but thank you. Yeah.
we like to break this down into 3 distinct buckets. So first of all, formulating it was not easy. It's a little bit of an unstable molecule. So getting the formulation right to make it ready for consumers was a bit of a challenge. And then 2, we put it into a 3-step system. It's not just a topical isotretinoin. It focuses on acne at the beginning, clear. We also have a second phase called fade, which focuses on dark marks, hyperpigmentation. And the third phase focuses on fine lines, anti-aging, things that you might want to focus on to keep your skin as clear as possible after your acne clears. So it's not just one product, it's really 3 different ones where somebody coming in, they can decide where they want to focus their skin concerns on.
I want to talk about pricing a little bit as well, because I see that IsoClear, it's available for $50 a month. You bill that as $100 for a 2-month supply. So if you do enter into a situation where you see other movers come in, you have the first mover advantage here. I mean, is that a lever you could pull? Could you cut prices from here?
So with pricing, it's always about volume, typically, to be able to get the pricing where the unit economics work. But obviously, we want to make it accessible to consumers. Right now, we actually offer financing for this as well. So people can break up that $100 payments into more digestible monthly payments as well. But price absolutely is a lever that we can pull.
All right, Michael, great to have you here. Michael Chang, he is the CEO of Clear Health, launching the IsoClear product here, the first topical prescription, first topical application there of the, I guess, what would we call Accutane medicine there. All right, it was a relatively subdued week in terms of market catalyst, but that's going to change in a big way next week. So let's set you up for what to watch, Katie Greifeld, over the next week. OPEC is out with their monthly oil market report, which actually might be kind of interesting given some of the big changes we've seen in the Middle East over the last few days.
Absolutely. The shifting geopolitical sands certainly has implications for the oil market. Tuesday is the big day. We get big bank earnings kicking off. Goldman, Citi, Wells Fargo, Bank of America, and JP Morgan, and also US CPI.
Yeah, we're going to get those US CPI numbers. The following, later in that week, we're going to get the PPI numbers. We're also going to get Kevin Moore. She's going to be on the Hill testifying for 2 days, both on Tuesday and Wednesday. But I want to push ahead beyond that, because on Thursday, this is what I think when earnings season really starts. We get Netflix. And there's been a lot written about them over the last few days.
Yeah, absolutely. Certainly going to be interesting to get those numbers and also to hear from the executives themselves. More eco data that day. We get U.S. retail sales, jobless claims. That brings us to Friday, University of Michigan sentiment.
Absolutely. And we'll, of course, be here to break down all of that market-moving action right here on The Close. There's still a lot going on the political front. Stick around. At the top of the hour, you're going to go down to Washington for Balance of Power right here on Bloomberg.